So last week we got a sense that politics was converging in terms of policy. This week we saw diverging monetary policy. So we had a lot of Fed speak this week, which was capped off by Janet Yellen speaking yesterday. And then we had the ECB, Mario Draghi, speaking as well. For us, that's throwing up some really interesting opportunities in portfolios because there's a divergence which allows us to play both themes which net off against each other in terms of a macro overview. In terms of the US, the questions that markets are asking at the moment is what is the balance between the tax cuts that we're likely to get on a corporate and personal level and the infrastructure spend that is going to come through. At the moment, numbers are looking at about a 1.25% GDP tax cut on a personal level, 1% on a corporate level. We're looking at 500 billion per year for the next 5 years on infrastructure. But you've got to balance that against what the trade protectionist elements are going to be, what's going to happen to NAFTA, what's going to happen to China, and the quantum of those and the uncertainty that they bring will slow the US economy. But for now, we are seeing quite a good tick up in GDP. This is the Atlanta Fed GDP Now Index, the most up-to-date indication of where GDP is going. And as you can see, that's been rising quite materially since the end of the month. At the same time, we're seeing very aggressive or steepening wage inflation coming through in America. Again, here's the Atlanta Fed wage growth indicator. So with claims at 30-year lows, with inflation going up, it's not surprising that Janet Yellen yesterday indicated that there would be a rate rise at the end of the year and there'll be likely a number of rate rises next year. So we've got to balance interest rates going up, the US dollar going up because of that divergent monetary policy against other economies, and the impact that's going to have on financial conditions, which will tighten. And therefore, perhaps the net effect on GDP will be far less positive than one might think at the moment. But we do have to set that against what's happening elsewhere in the world. So again, Mario Draghi this week said that they were looking for a sustained change in the path of inflation before they would change their monetary policy. And monetary policy continued to be a very important part of the ECB toolkit. Therefore, in terms of portfolio positioning, we've got some interesting opportunities. So on the US side, we're looking to get US exposure, domestic exposure, but we're also looking to get reflation exposure. Whether that's through the railroads, we recently updated Union Pacific this week to buy, or the financials that we've talked about. Here we've got a chart, a longer term chart of the US financial index against the MSCI World, which shows a significant underperformance despite the better performance we've had for the last week. On the other side of that, you can balance those growth stocks off with defensive holdings within Europe, and we've seen quite a big underperformance of defensives globally as people have moved into cyclicals, and therefore, if you look at the European Defensive Index on a 5-day view, you can see something like an 8% underperformance against the MSCI Europe. So that's a very big underperformance, and short term it looks very oversold. So opportunities to pick up stocks there. Equally, we see buying opportunities in those structural stories that we continue to like. It's been very difficult to find opportunities to get into these stocks, and we've been presented that over the last week as people have become more worried about the discount rate risk in these stocks, and also believing that there are equal growth opportunities elsewhere. So as you can see, the sort of overbought nature of the US tech sector has come back quite considerably, and therefore is offering an opportunity. Looking at next week, we've got Palo Alto reporting, which is just interesting in the context of our note, our thematic note on the cybersecurity that we have. We're playing that through an ETF called iSpy. Just drawing on what is going on in that sector, we continue to see big cybersecurity breaches, and again this week that's also occurred. And as you can see from this chart, you're seeing quite an exponential acceleration in those breaches. At the same time, the costs of those breaches is also increasing. So we think that structural story is strong, and you should revisit that note and Palo Alto numbers might be a catalyst for the sector next week. We've also got the autumn statement where we continue to think that UK tax receipts will be falling, growth will be falling, the cost of financing in the UK will be rising. So economically it will be a difficult sort of outlook, we feel, but also at the same time we feel that that deficit reduction will be put back to allow more targeted infrastructure or fiscal spending to come through over the next couple of years. So looking specifically at the week ahead, in terms of the UK covered, Killik & Co covered stocks, we've got Compass Group and AO World on Tuesday. In the States we've got Medtronic, and then on Thursday we've got Marston's reporting. That's it from me. Thanks for listening.